Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis, welcoming you to my podcast Money Talk for Tuesday the 4th of June, and thank you for listening and for making us one of the most popular business and finance podcasts in Hong Kong and Singapore, and also last month in Sweden and the United Arab Emirates, according to statistics from Podstatus. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, Indian Prime Minister Narendra Modi's party is set to win a decisive majority in India's election for the third time in a row when official results are announced this morning. Exit polls published on Saturday projected a clear victory for his BJP party and its smaller allies. Indian markets hit all-time highs yesterday as Mr. Modi's third term promises investors a continuation of market-friendly reforms and infrastructure investment. The benchmark BSE Sensex index surged 3.4% yesterday, with all sectors trading in the green. A private survey showed that Chinese manufacturing activity expanded at the fastest pace in nearly 2 years in May, contradicting official data released last week, which pointed to a surprise contraction. The Caixin manufacturing PMI came in at 51.7, slightly beating the consensus forecast of 51.6. It was the 7th straight month of expansion in factory activity and the fastest rate of expansion since June 2022. A top Federal Reserve official has called for interest rates to stay on hold for an extended period of time, saying lowering borrowing costs before inflation was under control would put the foundations of US prosperity at risk. Neil Kashkari, Minneapolis Fed president, also told the Financial Times that Americans' visceral hatred of inflation meant that some people would prefer a recession to a jump in prices. The US manufacturing sector weakened further in May, raising concerns about the strength of the economy. The Institute for Supply Management's index tracking factory activity fell to a reading of 48.7 last month from 49.2 in April. And the Atlanta Federal Reserve's closely watched gauge of economic growth, GDP Now, reduced the pace of expected second quarter growth down to 1.8% from a reading of 2.7% before the data. On today's Money Talk, we're joined by Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, Will Denyer, US Economist at Gavekal, and from Washington DC, our US Economics Correspondent, writer and broadcaster, Barry Wood. And as always, my Asia Daily newsletter is available at peterlewismoneytalk.substack.com, and it contains plenty more business and finance information from around the region.
Peter Lewis's Money Talk.
On Wall Street Monday, the Dow declined after data showed a slowing manufacturing sector in May, and ahead of a closely watched jobs report on Friday. The 30-stock Dow slipped 115 points, or 1/3%, to close at 38,571. The S&P 500 inched 0.1% higher to finish the session at 5,283, and the Nasdaq Composite that added 0.6%, 16,829. Energy was the worst performing sector, down 2.6% as crude oil prices dropped more than 3%. The yield on the 10-year bond extended its decline into a third session, falling 11 basis points to 4.39%, and the yield on the 2-year note shed 7 basis points to 4.81%. The US dollar index fell for a third consecutive session, dropping 0.5% to just above 104 after the ISM manufacturing PMI unexpectedly fell. The yen outperformed, rising 0.7% to 156.22, and the offshore yuan was steady around 7.25 renminbi per dollar following the Caixin PMI survey. Gold was given a boost by the weak dollar, rising 0.9% to $2,348 an ounce, and Brent crude oil, that settled 3.4% lower at $78.36 a barrel after OPEC Plus agreed Sunday to extend their official crude oil output cuts into 2025, but then gradually phase them out over the following 12 months. Mainland stocks declined for the third day, despite upbeat manufacturing PMI data in China. Sentiment remained downbeat as a report suggested that the US, along with its allies, could take steps against Chinese firms and banks over Beijing's support for Russia's war against Ukraine. The Shanghai Composite dropped 1/3% to 3,078. However, stocks in Hong Kong rose Monday, boosted by gains in Chinese electric vehicle manufacturers after Beijing announced $890 million in subsidies for vehicle trade-ins. China's top EV makers increased deliveries by up to 36% month-on-month in May. The Hang Seng Index climbed 323 points, that's 1.8%, to 18,403, and that ended 4 consecutive days of declines. The tech index surged 2.5%, and today futures markets pointing to a decline of about 80 points for the Hang Seng at the open, should start around about 18,320. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
On this Tuesday morning, let's welcome our guest. We have with us Mark Michelson, who is chairman of the Asia CEO Forum here at IMA Asia in Hong Kong. Morning, Mark.
Good morning. Good evening, Barry.
And also with us, Will Denyer, who is US economist at Gavekal. Good morning, Will. Nice to speak with you again.
Good morning, Peter.
And also with us over in Washington, D.C., our US economics correspondent, writer and broadcaster, Barry Wood. I think we're in the summer now, aren't we, Barry?
Technically, I'm not sure. Summer hasn't officially begun, but we always measure in the States after Memorial Day, and Memorial Day was last week. So, yes, and everything is fine. And temperature is about 25 degrees and clear.
Well, let's stick with the US to start with. Data out yesterday showed the manufacturing sector weakened further in May. The Institute for Supply Management's index tracking factory activity fell to a reading of 48.7 last month from 49.2 in April. That was below economists' expectations of 49.5. And after that data, the Atlanta Federal Reserve's closely watched gauge of economic growth took another sharp dive. GDP Now, which is the Atlanta Fed's branch's tracker of incoming data, reduced the pace of expected second quarter growth down to 1.8% from 2.7%. I think, Barry, it's fair to say, isn't it, the data is mounting now that seems to be showing a slowdown in the US economy. Not a contraction, but certainly quite a marked slowdown.
Yes, I think you've got it exactly right, Peter. It's a slowdown, and we shouldn't forget, this is what the Federal Reserve wanted. They wanted to slow the economy in the hopes that that would aid the fight against inflation. And I think it has. For example, you take Walmart and Target. They've made big advertisements saying, we have cut the prices on 5,000 goods. Well, that's significant because people are so obsessed or so panicked and so revolted by the high rate of inflation that, consumer sentiment is not good altogether. And it's also that people are not buying as much as had been expected. So I think those statistics you mentioned, Peter, are valid. The economy is slowing. The stock market seems, after the NVIDIA burst, has come back to earth. And this is a growth-restoring correction, in my view. So everything is going pretty well.
Mm-hmm. And Will, how do you see it from your perspective? It's been long awaited, hasn't it, this slowdown?
Yes, indeed. I was too pessimistic on growth last year, and it seems to finally be starting to cool off. And of course, the question is why? Why now? A couple of possible explanations. One is that the fiscal boost that you saw last year has weakened significantly this year. So last year you had deficit spending actually expanded. It's structurally high. That's not going to change. We've got large deficits for as far as the eye can see. But if you're looking at year-to-year marginal changes, last year was an expansion in deficits. This year is actually a contraction. And so some of that short-term boost has abated. I think that's a big part of it. You've also got a very strong dollar, which usually affects competitiveness, and it shows up in the trade data, for example, with about a 2-year lag, and we're right about due for a pretty significant impact there from the dollar on U.S. exporters. Now, the U.S. is not a very export-dependent country; it's largely domestic-focused, but on the margin, that could take some fire out of the U.S. economy as well.
Do you worry that there are signs, aren't there, that various elements of consumer spending growth all seem to be losing steam at the same time? You've got disposable incomes only rising modestly now. consumers running down their savings, sort of seem to be maxing up on their credit cards. Is that a worry?
Well, I think it is a worry, but it's not a significant worry. The consumer is still pretty strong, but if we get more bankruptcies and if we see interest rates really, for car loans, for example, continue to remain in the 20% area, mortgages are pretty steady at around 8% for a 30-year mortgage. But I think all of these things are really positive, and as the Fed wanted. I will make one prediction, Peter, that the Fed meets next week, after all. There will be an interest rate cut in September because the Fed has already said they want to do cuts. There won't be more than one, but there will be one, and that will have a very stimulative effect on consumer sentiment. We'll see. But, this is not an economy that's in trouble.
Mm. Well, when we look at those real spending numbers, if you exclude the impact from inflation, they're falling now, aren't they?
Yeah, so a couple of thoughts on that. First of all, I was just in the U.S. doing a business trip, and I will say that going out to eat in the U.S. is shockingly expensive. I mean, it's expensive when you look at the menu. Then I had one restaurant add some sort of, it was not large, it was like 3 or 5% charge. And I said, what's this charge? They said, oh, that's in lieu of raising prices, this is an add-on that we're doing. If you want us to remove it, you can. I was like, no.
That's a novel way of doing it, isn't it?
Yeah, it's very cheeky. And then after that, you get hit with a 20, 30% tip. I remember back when it was like, would you like to tip 10 or 15%? Now it's, it starts at 20 and goes up. And so, to some extent, I do think you may be experiencing some sticker shock, and it's, the high prices are just starting to weigh. That being said, I agree with Barry that the U.S. consumer doesn't look overall unhealthy at this point. So if you look at both sides of the equation, their income statement and their balance sheet, the income statement's sort of a mixed picture. Yes, salary growth or wage growth has decelerated, but it's still growing at a clip that we would have been happy with most of the last 20 years. Unemployment has ticked up a little bit, but it's still very low compared to recent history. And so on the income side, it's maybe not as strong as before, but it's fine. And then on the balance sheet side, actually the continued increase in asset prices we've seen continues to provide a positive wealth effect. So I have a hard time getting too bearish on the U.S. consumer until we see a more material deterioration in the labor market, or we start to see asset prices and that wealth effect turn down. Now we're going to get, the latest payroll data come Friday. You never want to put too much weight on one payroll report because it can be revised. But, if that shows more weakness, then that would be an argument for getting more cautious on the consumer.
Mark, we need a strong US economy for the region here, don't we? Because obviously we've got a lot of economies looking to relying on a strong US consumer to buy all these goods that they need to export.
Yeah, absolutely. And I don't want to generalize, but a lot of members of our forum are concerned. It's not that everything that Will and Barry have said, I think most people would agree with. But they're worried about the signs going forward. Of course, inflation's, as you said, is it under control? Is it not under control? Jamie Dimon doesn't think so. among many others, we just had the head of the Minneapolis Fed saying he doesn't think interest rates should be lowered in the near term. How that reflects the rest of the group, I have no idea. But at the same time, there are little mixed signals. And of course, looking at the U.S. election and voter sentiment, that weighs on these companies as well, because the view of the economy, Barry knows more about this than me, but the view of the economy among a lot of people in the U.S. is that it's not doing very well, and it's colored by inflation. So just what Will said, that's what people are experiencing.
I agree.
So when it comes to the Fed, I mean, Neil Kashkari, the head of the Minneapolis Fed, was basically saying people would rather have a recession than see prices rise. So he was basically saying that, look, we're going to ignore the signs of the slowing economy, and he doesn't want to do anything for several meetings until he sees signs that inflation are coming down. So if that is reflected generally in the Fed, presumably that means they're not going to cut rates for a while. But how much does his opinion sort of count and sway the rest of the Fed, the FOMC?
Peter, I think he was talking about his boss. He just couldn't say it. I think he was talking about Powell, who would rather see a recession than prices rise back up. I mean, I do think Powell cares a lot about his legacy and does want to be remembered as somebody who got inflation back under control. Yes, he will always be remembered as this central banker among many who let inflation get out of control in 2021. But he's been fighting very hard to get it down. And if you read between the lines, of course, he'd love to do that without causing a recession if he can. But if he has to choose between a recession and inflation down on target or reaccelerating inflation and no recession, I think he'll take the former. So, yeah, Kashkari might be talking about Powell.
Interesting.
Yeah, that's a very good point, Will. I tip my hat to you. Look, no one wants a recession. And the Fed would act quickly if there were signs that the economy was slipping into recession. But you've got an economy with record low unemployment. You've got an economy that is zooming along at a 1.5% to 2% annual rate. So, the things are all right. But what Will said about restaurants, first of all, the consumer is very confused because there's been a lot of local governments that have changed to go to the European system of tipping. Well, but they add on these fees, then they add another fee. And by the way, if you were taking out food, then if it goes to one of the, companies that deliver, that's another fee. You can't make sense of this stuff, and it adds up, and it makes it very expensive. But I think Kashkari reflects a almost unanimous view within the Fed. We're not going to allow inflation to rise again.
Well, I'm wondering then, could the Fed be in for a bit of a tricky summer because commodity prices are really volatile at the moment in a whole range of segments and generally sort of moving up. If you look at sort of gold, silver, copper, various agricultural commodities, lots of volatility there. So that could presumably impact inflation and keep inflation, above 3%, above the Fed's target. So could the Fed, have a bit of a tricky summer here? Are you seeing the same signs?
Sure, that could happen, Peter. But let's face it, gold and some of the other indexes you mentioned that have risen, that reflects the concern over the geopolitical situation in the world. The wars that are going on and the conflict between the United States and China. I think that if you look at oil, below $80, my goodness, this is positive. So I don't see that commodities are out of control. In fact, I think they're struggling to boost in most areas. But that's my view.
Mark?
Yeah, I just like to underline geopolitics. It's maybe we underestimate it because it sometimes comes down, but neither of the major wars is going well at this point, from whatever perspective, I think. And the light at the end of the tunnel is hard to see, even though we have a peace proposal in the Middle East, but it's not clear even if Israel, who supposedly made it, supports it, especially within the government, and Hamas has not even replied. In Ukraine and Russia, I mean, it's like almost like World War I in terms of the way they're fighting each other with artillery and other things, and just more people. So, what the implications of that? Further implications are they're just not positive.
Well, before we get onto the geopolitical stuff, let me just ask you about the inflation question. Could we be in for a summer of sort of quite sticky inflation, or are you more relaxed?
Well, first of all, you said it might be a tricky time for the Fed. And I would say, getting a few people into a room and deciding what the world's largest economy needs in terms of interest rates is always a tricky proposition. But yeah, when it comes to commodities, the difficult thing, first of all, I'll say that the most important commodity by far of the ones you mentioned is oil. So gold we can talk about gold. It's interesting that it has had such support in spite of tight Fed policy. I think that, as Barry said, has a lot to do with stuff going on in the rest of the world, has to do with, Japan's monetary policy still being loose, with China, property market not being the best store of value, there's other factors, and we tend to focus on what's going on in the U.S. But for oil, that's a difficult one because it's a very liquid market. We get updated prices all the time, and so I'm always cautious about stripping that out of inflation because in a way it's one of our best prices. It's better. It's a more timely reflection of what the market is thinking about the economy. And right now there's concerns about a slowdown, as you mentioned, and that's probably weighing on oil today. On the other hand, it is volatile. So the Fed, will look at what oil's doing. We'll look at inflation expectations. We'll look at overall inflation numbers, but they'll also look at things outside of oil just to make sure that they're not getting whiplash from a very volatile part of the CPI. So that's from a process perspective. What's the inflation outlook is ultimately, I think, your question. And I still have a bias toward disinflation in the U.S. I think you've had a unprecedented contraction in money supply growth. That is going to continue. It may slow down with the tapering of quantitative tightening, but it's still going to be a negative growth number. That doesn't ensure lower inflation, but it's definitely a drag. At the same time, you've got, supply bottlenecks are pretty benign right now. So, some of the inflation we saw in 2021, 2022 was you had order backlogs, you had supply chain disruptions. Supply was just really struggling to catch up with demand. We don't see that today. If anything, it's the opposite. So for those reasons, I think there's a good chance that inflation does moderate. I think it will take several months of benign inflation before the Fed has the confidence to cut. So I'm not sure I'm as confident as Barry about a rate cut in September. But if the inflation data does very clearly trend in that direction between now and then he may be right. But I think the Fed definitely wants to be confident that's the direction we're heading. And things like that positive wealth effect. There are counter forces that, if those strengthen, that's the risk to that scenario.
So you don't seem to be worried about the dreaded S word, which several people have been raising recently when they describe the US economy, i.e. stagflation. You don't see that coming.
Stagflation to me in the modern monetary system, I think really requires a major supply shock. Because if the economy is booming and people are excited and banks are extending credit and money supply is growing, you tend to have inflation positive and growth positive. And then when people get scared and start hoarding cash and banks start bringing in loans, you tend to get a disinflationary bust, aka a recession. The stagflation, where you have both high inflation and low output, to me, the most likely scenario where you would get that is some major supply shock, like an oil shock. Now, there's plenty of geopolitical question marks around the world that we can't rule that out. And, who knows, we could get hit with another pandemic or something. So I can't rule it out, but it's more of a tail risk to me than a core scenario.
Yes, sir. I agree.
And on some of the geopolitical issues, Barry, a lot's come out of the weekend because we had that Shangri-La dialogue down in Singapore. Lots of defence ministers were there, including the US and Chinese defence ministers. They met. The thing that seems to be concerning investors most of all out of all of these geopolitical issues is the risk that the US is going to punish Chinese firms that are helping Russia get supplies for its weaponry. They're talking about maybe banks as well. We heard that from Kurt Campbell, the Deputy Secretary of State, Wally Adeyemo, the Deputy Treasury Secretary, and then China saying that if its interests are damaged, it has all the tools necessary to respond. How big a risk do you see this?
Well, I suppose it is a risk, Peter, but I don't think it's a big one because, good heavens, the Chinese are not supplying weapons. They're not supplying drones. This is pretty easy to monitor, and that has not happened. I mean, when you start talking about, well, there's some bank financing that goes to a Russian company that may be buying things, that's very tough. So I think that was talk, and there won't be much action, and there shouldn't be much action. But I think it's exceedingly positive these people met in Singapore.
Yeah, I do too. I think the worry is I hope they worry about this is the blowback of any such actions on the U.S. and other economies. I think that could trigger all the things, some of the things that Will was warning about, if they do such a thing. I tend to agree with Barry, although I certainly don't know what they're going to do. The other thing is that came out of that meeting, in addition that China and the U.S. did not agree on Taiwan, clearly, was
surprise.
Was a strong statement by President Marcos of the Philippines, which may be not surprising, but that is a dangerous situation because they have real disputes there, and the U.S. is obligated by treaty to support the Philippines. What that means in practice is hard to know, but that's almost more of a worry than the Taiwan Straits at this point. So we'll see where that goes.
Will, any geopolitical issues on your radar?
Too many. Yeah, I mean, I was talking with somebody from the Middle East last night, and I was actually pretty amazed that the mood there, at least, is that they're not at all worried about the Israeli Palestinian conflict expanding into other territories. So that's or broadening out, which is positive. I mean, I hope that's true. It does feel like kindling at this point. But yeah, I mean, I don't have a strong view on which direction that's going to go. And Mark's already covered Asia. Hopefully cooler heads will prevail in all of these situations. But when you have multiple flashpoints around the world, the risks are high.
I want to ask you about Donald Trump. He's obviously been in the news. He's been convicted on 34 counts of falsifying business records. This means, by the way, that he's the first actor in Home Alone to be convicted of a crime. He says he's going to appeal. How much of this, Barry, is he seems to be making the most of this, doesn't he? Raising a lot of money from it. It doesn't seem to be damaging his campaign at all.
So far, you're right. But it changes day to day. Anything with Donald Trump is possible. But you're right, he's raising a lot of money, and there are signs that a lot of people say, what is this trial all about? I mean, what? And you ask people, well, what was the conviction for, these 34 counts? And a lot of people can't say, well, she paid the porn, etc. It's complicated. I think that we just have to stay tuned. There's nothing, it didn't hurt him. The idea that a man is going to be behind bars and running for president. Thus far, that hasn't surfaced much. Sure, there are some Republicans who say, well, good heavens, I'm not going to vote for a man who's a convicted felon. But maybe he won't be a convicted felon if they appeal in time and get this kind of decision that they think they would get. So stay tuned, and it's very hard to make any prediction at all.
I agree. I mean, obviously, some of the polls have shown that the margins, it might affect some independent voters and others, but I think it's far too early to tell that sort of thing. But what it does do is question what's the support for the U.S. justice system and for other sort of aspects of sort of the basis of the U.S. system. And that's not just from Donald Trump, but it's from so many others that have questioned whether it's fair or not. Even though, obviously there were some evidence that you might question, but there was a jury of 12 people that convicted him. It may not have been right, but they did it. And that's how the system operates.
Yep.
That's basically what President Biden was saying, wasn't it? You don't disparage the justice system just because you don't like the result.
But it only resonates with the most half of the U.S. populace, maybe not even that many.
Well, Will, from an economic perspective, how do you try and factor this in, the possibility, maybe the likelihood, some people will say, of a second Trump presidency?
Well, I'll just say that Home Alone is still my all-time favorite Christmas movie, despite the fact that Trump was in it. And am afraid that Trump is likely to win again, despite the fact that he's a convicted felon. And that's basically based on the evidence from the last time around. I mean, who would have thought that a president could win the Republican Party and specifically the Bible Belt, weeks after that, which I won't repeat what was in it, but weeks after those tapes were released right before the last election. I mean, that just upended everything I thought I knew about the South. And I'm from the South. I'm from the Bible Belt. So, I mean, he is the Teflon candidate. So I agree with Barry. There's no signs that this is hurting him. From an economic perspective, the way I've been thinking about the election is through the lens of the exchange rate. And it also obviously has implications elsewhere. But I think a Trump win is likely to be dollar positive initially, largely for tax reasons. Trump is much more likely to keep corporate taxes where they are, probably not cut them, but it's at least possible, I guess. Whereas Biden would be more likely to increase corporate taxes. So Biden would be dollar negative in the sense that would weigh on the competitiveness of U.S. companies, that would weigh on the dollar, whereas a Trump win would be dollar positive on that front. Then you move over to tariffs, and Trump would have both presidents have learned to love tariffs, but Trump seems to love them more. So there's a higher risk of tariffs going up. That's also dollar positive. Trump is more likely to cut regulations than increase regulations. That could also improve the competitiveness of the U.S. That's also dollar positive. So all of those taxes and regulations, I think that will probably be the obsession of markets initially if Trump wins. And that'll be probably dollar positive, could be equity market positive and bond negative. And for the economy in general, positive initially. My concern is going into 2026 when Trump will have a chance to replace Powell, whose term will be up then. If he decides to replace Powell with a political lackey, more like Arthur Burns, that's where that dollar strength could give way to significant dollar weakness if that starts to call into question the credibility of the central bank. So, Mark was just bringing up the credibility of the justice system. That's another threat to another institution that we can look forward to.
I agree, and I like the reference to Arthur Burns, which is really obscure, I think, as far as many people are concerned, but I certainly understand it. Yeah, no, I agree, and I think that in terms of tariffs, and there was just a comment by a well-known economist yesterday, it was Chatham House Rules, so I can't say who, but Hong Kong would recognize his name, that the tariffs that were just imposed by the Biden administration, although touted as limited because on EVs, of course, because not hardly any EVs are sold in the United States, and it's really a small market. It's on top of the tariffs that are already there, and they haven't really been taken away. So I'm not sure. Trump has suggested that he might impose very high tariffs, and I don't know if that's true, but certainly the approach and Trump's approach and the Biden administration's approach are not that dramatically different. They both are relying on this tool as one of them, and they both don't support the existing rules-based international system, which is centered partly on the WTO.
I completely agree with you, Mark.
Change. Yeah.
I completely agree with you. I think on tariffs, it's just a matter of degree. I think where the more stark difference is on the domestic policy and corporate taxes and regulation.
Absolutely.
And sorry, you're right. I should have mentioned who Arthur Burns is. So Arthur Burns is the central banker in the 70s who, let inflation get out of control and gave in to political pressure to be easier than he should have. And he's, the dichotomy. The comparison usually made is between him and one of his predecessors, later central bank chiefs, Paul Volcker. And Powell would much rather be remembered as an inflation warrior like Paul Volcker than a political lackey like Arthur
Absolutely.
Burns.
It's got to add a few inches, but maybe.
It does seem that the Fed's going to come under a lot of pressure, though, doesn't it? Which is, as Will was saying, is going to be a concern because the independence of the Fed is sort of part of the mainstay of the U.S. economy.
Well, I would think that Jay Powell would welcome retirement. I mean, if he can claim and show from data that he defeated inflation, this would be a triumph. Why not give it up?
Go out on a high.
After all, he was appointed. He was appointed by President Trump. And people forget that.
He was, but I think Trump made it pretty clear that he would get rid of him if he had the opportunity. I think he regrets that. He regrets that appointment. And so I do think Powell has shown himself to have a backbone in 2018 and 2019 when Trump was sending angry tweets at him all the time, quit doing quantitative tightening, quit hiking rates. And he said, thanks for your opinion, but no thanks. I'm going to keep doing what I'm doing. And so I have a decent amount of confidence. I mean, it's not 100%, but I suspect Powell will hold the line on whatever he thinks is appropriate until 2026. And the concern is who he's replaced with.
Okay, let's turn our attention to another economy also having an election, and that's India. Prime Minister Narendra Modi's party looks set to win a decisive majority in India's election for the third time in a row, when official results are announced today by the Election Commission of India. No Prime Minister since Jawaharlal Nehru, who ruled India for 17 years after independence, has managed to secure 3 consecutive terms in power. Equity markets were euphoric yesterday about the prospect, including more investment and more spending and basically market-friendly policies. Mark, this is obviously, first of all, a triumph for democracy, isn't it? 7 weeks, 1.2 billion people to try and organise that. No mean feat at all. But nevertheless, this is a significant election.
Yeah, I think we have to say managed democracy, because several candidates weren't allowed to run. Some were prevented from expressing their opinions, et cetera. But still, certainly, and look, almost a billion people voted. So that's a fair number. I think it's a real triumph of, first, his policies, because I think, unlike in the United States, a lot of Indians feel better than they did 5 years ago or whatever it was. So that's important. So economically as well, and politically, it's been a masterful class in, first of all, the opposition is weak, but in being able to deal to actually woo some areas that have never been big supporters of BJP, like south of India, Kerala, by focusing on Christians and saying, look, the Muslims are threatening you in Kerala, maybe you should vote for us. So it looks like he did pretty well there. Same and in other areas as well, using celebrities and so on. However, exit polls in India as well as elsewhere are notoriously not accurate. But the question is how many seats he gets. Are they going to get the 400 seats that they're aiming for, which would give them a supermajority and would have implications of what constitutional changes and so on that could really influence India going forward. And the only other thing I'd say is that he's strong, he's popular, but what happens if he's not there? And again, succession is always, as often true in India and other places, is not clear at all. So that would be, I guess, another worry, at least on the back burner.
And we should mention the economy. GDP for the fiscal year that's just ended was 8.2%. That makes it the fastest growing major economy in the world. For the first quarter, for January to March, GDP grew 7.8% from a year ago, much higher than what economists were predicting. So quite a remarkable growth story here going on.
This was brought up. We had our monthly meeting, which is our open agenda meeting of our executives, and one leading Chinese executive mentioned that, because I think that's a sensitive issue as far as China is concerned.
I should imagine, Barry, that there is opportunity here for the US, isn't it? I mean, this is a huge market. The US has obviously got problems with China, but here is another huge market in Asia that is expanding very rapidly, investing in construction and manufacturing, is going to be providing sort of cheap goods for the world, including the US. There must be plenty of opportunities here for the US and for India to maybe get closer.
Absolutely. It is that de-risking, and India is a beneficiary of that. But let's not forget, 20, 30 years ago, until far more recently, the main supplier for the Indian defense was Russia.
Russia.
That's all shifted now towards the States. And I hate to say it, but it looks like we've got a very powerful military-industrial complex once again in the USA. And India is an important market. What else are we going to sell them? Everybody's skeptical about Boeing. We sell airplanes, but maybe some turbines from GE or whatever they call the company now. But you've also got some logistic things. So India rising, maybe that's premature, but boy, that's an impressive number you mentioned about growth.
Well,
just one addition. It's certainly in China Plus One. It's among our members. I guess it leads the poll in terms of what China Plus One is. But still, in terms of manufacturing, despite the inroads we've seen and the growth we've seen, it still is very small, especially compared to China. And in terms of reliability and quality, there also are other issues. So those remain.
Well, I mean, is this a possibility for the US to expand supply chains through India? It wants to reduce its dependency on China. Is this a reliable prospect?
Well, Mark has more of a thumb on this than I do. But I think obviously before the election that was already underway, China Plus One, as Mark put it. But also, everything I've heard is consistent with what Mark is hearing as well, which is that India does have opportunities and companies see opportunities to expand manufacturing there, but it's nowhere close to a perfect replacement for China yet in terms of infrastructure, in terms of the network effects of supply chains. But how quickly that happens remains to be seen. But I think in terms of whether this election's a positive or negative, like you said, it's the economy, stupid. It's been doing well under the current leadership, so I imagine companies are happy with consistency there.
And finally, let me just mention China. We had the Caixin Manufacturing Survey out, which surveys smaller private firms, and that came in at odds with the official survey, which surveys large state-owned enterprises. The Caixin Manufacturing Survey expanded, came in at 51.7%, slightly beating estimates, the seventh straight month of expansion in factory activity. The official PMI, which came out last week, actually showed contraction in the manufacturing sector. I was interested in what Paul Krugman was saying, Nobel laureate in economics. He says China's leaders are bizarrely unwilling to use more government spending to support consumer demand instead of production. He said the fact we seem to have a complete lack of realism on the part of the Chinese is a threat to all of us. And he says China's whole economic model is not sustainable because of vastly inadequate domestic spending and a lack of investment opportunities. And he said Beijing should be supporting demand, not more production. This is something that we've heard several times, Mark, isn't it, about the production side. But of course, maybe it's not so bizarre to understand it because it involves a whole change in the sort of the economic and the political structures of China, which are very much geared towards supporting manufacturing and exports and the supply side.
Investment, yeah, exactly. And in our members, and again, you can't generalize too much, we still are not seeing that upsurge in consumer spending. Some, but not nearly meeting expectations, and waiting for government stimulus. Not sure if that would have an impact. But it's interesting. I just heard the IMF deputy managing director talk about China, and even though they just raised their forecast for China, she said some of the same things that Paul Krugman said. Not quite as dramatically, but indication that more should be done to boost consumer demand, which, of course, the Chinese government has said that they're going to do and has been saying they're going to do for some time. But part of the issue, we've talked about this before, and that was mentioned in a couple of discussions recently, is the social safety net and the lack of confidence in that for a lot of consumers. That's a combination of medical, education, to some degree housing, and the overhang, of course, of the property market issues, which are not resolved yet.
Well, I think Paul Krugman's got it exactly right. I agree with Mark. We shall see where this ends up, but we're headed for a collision with China, not just the United States, but Europe, because they're sending all of this excess production abroad. And I think stay tuned over the next few months, because I think that's going to be a real cause of conflict.
Will?
So I'll play devil's advocate here. So I think Beijing's response to Krugman would be, yeah, how did that work out for you in the 2000s?
All right.
Boosting consumption, telling everybody to go out and buy McMansions and not doing anything to support your manufacturing sector. How'd that work out for you? So I think Beijing has seen what happened there and decided to go the other route. Now, in my opinion, they've gone too far. I think I'm not completely supporting by any means the industrial policy of China. I do think whenever you have a central government deciding, oh, we need this many solar panels and we need this many cars, you're going to end up with malinvestment and too much of some things and not enough of another. So I'm not supporting the policy in that respect. That being said, I think the other thing Beijing would say to the U.S. and Krugman specifically would be, if we're screwing this up so badly, why are you guys so worried about our rise? Why are you throwing all these tariffs on us? Why are you saying we're a strategic rival? We must be doing something right. So I'm not sure I'm entirely in Krugman's camp on this one.
No, I agree with Will. I mean, it is, China has done well. Again, one of my concerns is, again, the social safety net and reform of the hukou system, which, again, the central government's been talking about for a long time, but it's very politically difficult within China to do that. And so, that and the overhang of COVID, which still is affecting China as well as Hong Kong, I think that contributes to the unwillingness to spend in the way that they could.
Okay, well, thank you very much for a very interesting, very lively discussion this morning. You heard there Mark Michelson, who is chairman of the Asia CEO Forum at IMA Asia, Will Denyer, US economist at Gavekal, and from Washington, D.C., our US economics correspondent, writer and broadcaster, Barry Wood.
You're listening to Peter Lewis's Money Talk. Money Talk.
Thank you for listening this morning. I'm going to be back tomorrow with more business and finance headlines. To discuss them, I'll be joined by Enzio Von File, capital preservation specialist at Financial Shield, and Tim Huxley, chairman of Mandarin Shipping. And with a view from Japan is Tokyo-based journalist and author William Pesic. Please subscribe to my daily newsletter, which contains updates on business and finance news from the Asia-Pacific region. You'll find it at peterlewismoneytalk.substack.com. See you tomorrow.
Money Talk